Good morning and welcome to NDTV Profit. This is Talking Point. I'm Muralidhar Swaminathan. My colleague Niraj Shah will join in a while. He's had a long morning and he's taking a short break. He'll come back. But the other Mr. Shah, Nilesh Shah, MD of Kotak AMC. He is an expert on markets, manages one of the largest mutual funds. We don't need any special introduction. He is also busy and we can see him. He's stuck in a car in a traffic. Nilesh, good morning and welcome to NDTV Profit.
Thank you, Murli. My pleasure being here.
Okay, so I will start with the first question. What is the root cause of the current sell-off? Before we go on to other questions, what is your assessment? What do you think has triggered this big sell-off?
Murli, the simple answer is that sellers are more aggressive than buyers. Why have suddenly sellers become aggressive? One, partly it could be profit booking. Our markets have delivered tons of return to investors. And in a risk-off market, people don't mind booking some profit. Second, there are concerns emerging globally. Some people say it is yen carry trade reversal. Some people say it is geopolitical risk in Bangladesh, Israel, Iran, and so on and so forth. My feeling is that it's a combination of everything, which is pushing sellers to sell aggressively and buyers to bid conservatively. That mismatch is resulting into market correction.
Right. So how much weight will you put to this fear of US recession? Because, that was used, the jobs data was used by players in the US market on Friday to say that, look, recession fears are back and that's being seen as one of the reasons. How much weight will you put to US recessions?
So one, the whole market has been going wrong about US economy, including US Fed. From inflation is transitory, it will remain elevated for a longer time, to now looking to cut rates to support economy, has shown how difficult it is to predict US economy, even by the mighty Fed. Our knowledge on US economy is limited, and our linkage to US economy is also limited, bearing sectors like technology which get influenced significantly by US economy. Our domestic focused sectors have very limited linkage with US recession. So my feeling is that our markets have run up a lot. People don't mind doing some profit booking. And the cause could be US recession today, Fed cut tomorrow, yen carry reversal day after tomorrow, and geopolitical risk some other day.
So it could be any reason to book profit in an overvalued market. You really brought to light in your tweet last week about how a segment of the market is so overvalued that we are discounting some 50 years of earnings. Can you throw some more light on it? And meanwhile, I'll also welcome my colleague Niraj. Niraj is also joining me in this conversation. Go ahead, Nilesh.
So essentially, it was back of envelope calculation to show how market is far more forward-looking. There are about 359 stocks which have delivered more than 100% return since COVID low in BSE 500. There are more than 28 stocks today compared to 93 stocks in 2020 pre-COVID, which are trading at more than 50 years. That means they are discounting the earnings of company as much as in 2074. Third, we looked at returns from COVID days. The return for broad market was coming at 22%, whereas the 20-year return came at 14%. It meant that from 2004 to 2020, the returns were subdued. And then 2020 onwards, the return took off, which means that at today's valuation, one will have to moderate return expectation. So this was more of a back of the envelope calculation on BSE 500 to suggest how markets are far more forward looking and extremely optimistic about future. Undoubtedly, if earnings growth continue their momentum, then these numbers will change. So limited point here, markets are optimistic. They are discounting future very, very positively.
Neeraj, would you like to step in?
Yeah. Nilesh bhai, one question therefore. Does this make markets vulnerable to a large drawdown? Or do we all need to rethink how we're looking at markets simply because the nature and the power of the local investor in the last 4 or 5 years is very different from what it has probably ever been?
So, Neeraj bhai, there are many people who say this is all due to domestic money. Undoubtedly, it is domestic money, but no one comes here to lose money. They all come here to make money. And in the markets, we have all kinds of people, some experienced, some not so experienced. My feeling is that overall people are positive on Indian economy. There is visible growth, there is good governance, and there is good corporate profitability. While despite market run up and trading at all-time high level, our valuations are not at all-time high level, albeit it is trading at premium to other peers. So my feeling is that it's a combination of not just liquidity, it is also confidence about the future growth. And to all those people who are bearish on Indian market and believes this is a bubble, I have always asked one simple question. Are you willing to short Nifty at this level for next 10 years? So far, I haven't met anyone who is interested in taking my proposal.
Okay, but 10 years may be a long time. I'm just trying to understand because your post then would have made one think that is Nilesh Shah cautioning about the valuations, and could Mr. Nilesh Shah be bearish for a shorter term? I know you don't take tactical calls and you're a mutual fund guy, so you won't do this. But if you are not, would you believe there is a probability or a higher probability of a correction in the Indian markets currently? We've seen 4%. Can there be more?
So, Neeraj, it is always difficult to predict the market in the short term. In March 20, how many people would have predicted that Nifty will be trading at 25,000 or 24,000 in 2024? Hindsight, it is always easy to say, oh, this is yen carry trade reversal, this is geopolitics, this is US recession. But trust me, more people have lost money waiting for correction than actually in the correction. All we are saying is that one, market is optimistic about future for right reasons. Second, valuations in many cases are reasonably well ahead. And third, please moderate return expectation and invest with a longer term horizon.
Okay, so we will not go back to predicting where the indices would be, but this question will be about factors going forward. What are the factors that will move the markets? Now, this is fundamental because at one end of the globe, you have US which wants rate cuts, and that could be coming in a few months. And at the other end, you have Japan which is hiking rates. It might put a little pause to hiking rates, but it is on that path. So you have a divergent global interest rate scenario that is emerging. How will markets react to this? Will there be a lot of shuffling around among different asset classes, like moving from equity to bonds, bonds to oil, and back and forth?
So, Murli, undoubtedly, asset allocators will try to sell what is expensive and buy what is cheaper. There will be undoubtedly those movement. Side mein khada. Now, if we look at India position, my feeling is that investors will look to buy into correction. Let's look at from a foreigner's point of view. The foreigners are today either equal weight India or marginal underweight India, there is a reasonably good chance that India's weightage in MSCI Emerging Market Index will go up. This will make many foreigners underinvested in India. Can they afford to remain underinvested in a growth market like India? Answer is undoubtedly no. So they will be using correction as an opportunity to invest. In every single IPO coming out of India, OFS coming out of India, we are seeing foreigners looking to buy and compete with mutual funds aggressively. Now let's look at domestic investors, insurance, mutual funds, pension funds. We all will be a buyer of India growth story. Let's look at retail and HNI. People who are expressing bearishness in the market are ultimately looking to buy at correction. So overall, my feeling is that corrections will be bought into. This time, investors have also become matured. This is real life Lagaan movie being playing out. As you know, in Lagaan movie, local team defeated foreigners. In COVID time, we saw one day international being played out, where foreigners were selling for March, April, May, June, July 2020. They sold close to 70 to 80,000 crore cash equity. Retailers via mutual fund kept on buying. Then foreigners realized that Lagaan mein jeetna mushkil hai. So they started playing test match. From October 21 to June 22, they sold 250,000 crore worth of equity. Retailers kept on buying slowly and steadily. Finally, foreigners realized that retailers are going to win test match also. So they gave up on test match format, came into T20 format. On the election result day, they played like T20, sold about 21,000 crore in cash and about 8,000 crore in futures. Retailers bought that into. So my feeling is that there is a real life Lagaan being played between domestic investors and global investors, and everyone will be looking to buy into correction. Now, someone may buy a 10% correction, someone may buy a 20% correction, but every correction will be bought into by local and global investors.
You know, in fact, yesterday you and your other colleagues in the industry must have bought what FIIs sold because FIIs sold 10,000 crores worth of shares and the domestic funds bought about the equal amount, 9,500 and odd crores.
Undoubtedly, mutual funds have asset allocation and balance advantage product, which can buy whenever market dips. The SIP flows have been very strong. And there is also new money coming in from retail and HNI investors whenever there is a correction. So there is a reasonable amount of depth in Indian market. Our fundamentals are good. Our governance standards are good. And we, provide one of the best opportunities on a price to earnings growth basis in emerging market. Now, gold doesn't come cheap. You have to pay the price of gold to buy gold, and which is where Indian markets are trading at premium valuation to others. But that doesn't mean that our markets cannot go down. Of course, they'll go up and down like any other market.
Okay. Okay. Nilesh bhai, the other question is a tale of two halves, if you will, or a barbell approach that Indian markets currently have, wherein people, there is enough opinion out there on what some of the, on the frenzy on some of the stocks, for example, in the defense space, in railways, in the EMS sector, etc., all of which probably form a part of those stocks which are above that 50, 70, 100 multiple, right? And the other end is the safety in valuations, but not the kind of growth that that the expensive names are showing. I would love to understand the current stage. Would you believe that there is merit in choosing safety in valuations over the kind of growth numbers that some of the expensive names are showing?
So Niraj bhai, you hit the nail. Value is what you get and price is what you pay. This is the market where you focus on quality over momentum. This is the market where you focus on reasonable valuation over expensive valuation. This is the market where you focus on diversified ownership and market discovered prices than low floating stock, concentrated holding, and market manipulated prices rather than market discovered prices. Now, in many stocks, holdings are concentrated in few hands because there is very, very low floating stock. This is resulting into valuations which are way ahead of their fundamentals and puts tremendous pressure on companies to deliver growth which is well beyond their capacity, in our opinion. Now, will this stocks correct today or tomorrow? I don't know. Will they correct when supply emerges, when minimum public shareholding norms are enforced, when some of the promoters of these companies realize that my shares have really run up and let me book some profit? Be the case as it may be, whenever supply emerges, the stocks are likely to fall quite sharply. And hence, focus on quality over momentum, high floating stock market discovered prices versus low floating stock and concentrated holding, and focus on reasonable valuation over expensive valuation. Do remember, price is what you pay and value is what you get.
Right. Now, if we have to focus on quality and liquidity and the stability part of what you're saying, what is the size of that basket of stocks? Is it 100, is it 200, or is it 300? Because anything beyond 200 or 300 looks quite vulnerable from all the factors and criteria that you have mentioned, Nilesh.
So today, if we look at large caps, maybe 70-80% of large caps falls in that bucket. If we look at small and mid cap, in mid cap, maybe the ratio is 50-50. Small cap ratio reverses to maybe 30-70. So there is opportunity in all basket, small, mid, and large. There are some stocks across private banks, technology, chemical, and consumer discretionary, where valuations are still reasonable, below or around their historical averages. Growth looks fine, and hence one can look to invest from a valuation point of view. It does not necessarily mean that they will start outperforming market from tomorrow onwards. Unless until supply emerges, it is unlikely that low floating stock counters will correct. Their prices can rise even further, but eventually they will correct. And hence, for an investor, it is a trade where you keep on reducing your holding in low floating stock, expensive valuation stocks, and try to buy high floating stock and reasonably valued counters.
Yeah. So, what about FMCG sector? Is that does that fall in this category? Because they are always assured of growth. They grow with the economy. They grow with the changing trends. They grow with monsoon, and they are not huge capex heavy companies. And what do you think FMCG would be? Because they move very slowly in the markets.
So again, FMCG companies cannot take their business for granted. They have to keep on investing in the brand. Their brand should remain relevant for the new sets of consumers which are coming in. And most importantly, they have to invest in distribution. Murli, just to give you a small example, under Pradhan Mantri Gram Sadak Yojana, rural connectivity has gone up substantially. There were, let's say, old FMCG companies which were serving mainly urban India and semi-urban India, but not rural India because of lack of connectivity. When this Gram Sadak Yojana started building connectivity, they probably didn't move with the time. And that allowed emergence of many FMCG companies which are leveraging rural road connectivity to capture rural market. Now, this requires different skill sets of distribution, but people who are early mover in capturing rural market, they are witnessing growth. So we have seen product categories where in couple of states, this kind of companies are able to sell what established companies sell all over India because of their connectivity, because of their penetration. So my limited point is that yes, FMCG looks good. Election has put money in the pockets of consumers. Budget is spending on skills and apprenticeship allowances, and there is also likelihood of good monsoon. All these things will put money in the pockets of rural consumers, and that should work well for consumer discretionary companies.
Nilesh bhai, I have one final question. You're sitting in the car for us, so I'll make this quick. What to your mind is the probability of a further drawdown? Is it purely Indian valuations, or will it need to be something global in nature? It could be a yen carry trade, it could well be a geopolitical peace, or Fed rate cuts not happening, or what have you. What is, or something else that you may have thought of? What could be the biggest known factor? I know usually it's an unknown, but what amongst the known factors could be the big factor?
So Niraj bhai, how many people were talking about yen carry trade reversal 10 days back? It was unknown, and it came and hit, and today everyone is giving yarn on yen carry trade reversal. All I am saying is that let's bow to the might of the market. It is well beyond any individual, and we have to just focus on how do we react to the correction. Every correction provides an opportunity to participate in long-term India growth story. Choice is yours. Do you want to be a trader going up and down with daily swings? Or do you want to be an investor using every correction as an opportunity to buy?
Okay, Nilesh bhai, we will leave it at that. Thank you so much for taking the time out and being with us. Really, really appreciate your time this morning.